Hi everyone, my name is Jay Bojani and we are here for discussing your paper 8B, that is Economics for Finance. I know not everybody is very fond of economics, so you might have a preconception that this is going to be a boring subject and this is not going to be as fun as other subjects. But trust me, this is a very interesting, very engrossing subject. If understood properly, this is going to give you a good insight about how an economy works. One thing which has majorly changed in your economics as compared to CA Foundation is that in CA Foundation, your economics was primarily microeconomics, right? You were learning business economics in CA Foundation, which deals with mainly microeconomics. On the other hand, the subject that we are going to cover here is economics for finance, which is entirely macroeconomics. Okay, so this is from the perspective of the economy, not from the perspective of one individual, not a household, not one particular business, right? This is from the point of view of entire economy. And that is why you are going to be able to relate this with many of the situations that you see going on in the economy, right? It's a very interesting subject, very beautiful subject. And since this is the first session, before I take up the actual contents of the subject, I will be giving you an overall idea about what the subject is made up of, the structure of the subject, and then after we'll be going to the discussion of the subject contents. Okay. So I have just scribbled down a few things about the subject. As you can see, we are talking about your paper 8B, which comprises of 40 marks. Paper 8A, the segment A of this paper 8 is financial management. That will be for 60 marks. That's a different subject. Economics for finance, which somehow is also related to finance, but this is again a different subject that we are going to study, and it comprises of 40 marks. The subject is divided, guys, into 4 chapters. Okay, don't be so happy. It's not just 4 chapters. Each chapter has multiple units. So chapter number 1 has 2 units. Chapter number 2 has 4 units. Chapter number 3 has 3 units. And chapter number 4 has 5 units. So in total, we are going to be covering up these 14 units. Okay. So 14 units, 40 marks. Or I should actually say 4 chapters, 40 marks. Sir, what about the marks weightage of each chapter? See, as you already know, ICAI does not give exact marks for each chapter. But yes, ICAI does issue a guideline regarding the marks weightage, which will help the students prepare better. So, in that guideline, ICAI has suggested that each chapter will be around 20% to 30% of the subject marks. So, what is the subject marks? 40. 20% of 40 being 8 marks and 30% of 40 being 12 marks. Okay, that means each chapter is going to be somewhere around 8 marks to 12 marks. More or less, the weightage of each chapter is same. So even if the first chapter has only 2 units, its weightage is more or less same. Right? So please do not try to differentiate between the chapters based on their relevance in terms of marks. Each chapter is equally important for you as far as marks are concerned. Okay. Now, sir, what type of a paper are we going to face? See, your paper, 40 marks paper, will be divided into 3 types of questions. 2 mark questions, 3 mark questions, and 5 mark questions, which are mostly numericals. 5 mark questions, they are mostly numericals. Okay, 2 marks and 3 mark questions are theoretical, majorly, right? So the paper is a mixture of theoretical questions and numerical questions. So if you had a notion that economics is only going to be theory, that notion is broken now, right? The paper will be comprising of theory as well as numerical questions. However, the theory component would be greater as compared to numericals. So as of now, the trend which is currently prevailing, as per that, the numerical questions are around 10 marks. out of 40, around 10 marks questions will be numerical questions, and the rest of the questions will be theoretical questions. Okay. The one good thing about theoretical questions is that they are only for 2 or 3 marks, which will mean that you will not have to write too much for every question's answer. Now, had it been a 10 mark theory question or a 8 mark theory question or a 6 mark theory question, it would have been quite difficult for you guys because you would have to explain very much in detail. Instead, what ICAI is currently doing is that it is seeking only the 2 mark, 3 mark answers from you guys. That means you will have to explain quite in short, to the point. Okay, which is a good thing, I believe. Okay, the disadvantage for that is that you will have to remember almost all the topics. So there are no less important topics or unimportant topics now. Even if there are, they are very rare. So you will have to more or less focus on all the topics with equal importance, because for 2 marks, 3 marks, anything can be asked from anywhere. Okay, so that has an advantage as well as a disadvantage for you. So that is how your paper will be divided. And I have just written the names of the 4 chapters here. Units will be taking up as and when we progress to the chapter. But for now, just for your reference, for your knowledge, I have kept the names of the chapters here. As you can see, chapter 1 is about national income. I am sure everybody has heard of the term. Chapter 2 is about fiscal policy. I am not sure if everybody would know about fiscal policy, but these are the policies which are designed by the government, central government, for the economy. They are known as fiscal policies. Okay, just like government designs industrial policy, right? Similarly, there is also a fiscal policy. Then third chapter, chapter number 3 is money, right? There's no doubt that everybody is going to love that chapter because it's about money. And chapter 4 is about foreign trade. Okay, so all good topics, interesting topics we are going to be taking up, right? And this is your overall subject structure, and please keep a note of this so that whenever you want to refer, you will be able to look at the details which are given here. Now we are going to go to the subject. Okay, now our subject, guys, is going to be discussed here in our sessions in 2 parts. Okay, the first part is the discussion which will be taking up through presentations. You will be watching presentations being taken up here during the sessions, and that will help you understand the concept of the topic. Now, once you have understood the concept, I'll be taking you to the notes, on-screen notes, and you will also be getting the copy for that. And now those notes are something for your reference, for your ease of writing, and our job here is to relate whatever you have studied in the presentations with the notes that you have. Okay, so that will be the second part. So for each topic, or at least each major topic, what we are going to do is that we are going to first understand the topic from the presentation, and then after we are going to be going to your notes and will be marking all those things which we have covered from the presentation and see how they are presented in your notes. See, my simple understanding is that presentations will help you understand better. Notes will be able to help you write better. Only understanding is not sufficient, right? You will need to present that properly as well. So the intention of going through the notes right here in the sessions is that you are comfortable with the writing part as well, and presentations will make the understanding part easy for you, right? So with those dual intentions, we'll be taking up this dual mode of study. So with that clarification, now I think we are ready to start with the first unit of the first chapter, which is known as the National Income Accounting. Your chapter 1 is determination of national income, and the first unit of that chapter is National Income Accounting. Now this is a very, very important unit for you. because you might be asked a numerical question from this one. Okay, very high chances in fact that you will be facing a numerical question from this particular unit. So we are also going to solve some numericals at the end of the unit, right? Now if I give you a highlight of what the unit contains, see, the unit will have number one, the meaning of national income, right? Then we'll be discussing the significance, the importance of national income. Why do we need to know about national income in economics? Why is it important? So that is the second thing that we'll study. Then after, we will be discussing about the concepts of national income. I'm sure you must have heard some concepts like GDP, NDP, GNP, NNP. During your school days, you would have definitely gone through some of these topics, if not all of them at least. Right? So that is the concepts of national income. And then we'll be covering up the measurement of national income. Then finally, we'll be going towards the limitations aspects. And then lastly comes numericals. Okay. So, all set? Ready? Let's start. Now, introduction to national income accounting. See, first thing that you need to know about national income is that in simple terms, what do we mean by national income? So, I would say national income is nothing but the income which is earned by the people of the country during an accounting year. That would be the national income of that country for that year. Okay, so whatever income is earned by the people of the country during an accounting year is nothing but its national income for the year. Now this is the simplest version of the definition, okay? The definition gets technical as we progress further. We'll be taking those aspects as well. But for now, for the ease of understanding, we are going to remember this definition, that national income is nothing but the income earned by people of the country. Okay. So why do we need to know about the income earned by people of the country, sir? Why do we need to know that? See, simple. Just like in any particular business, we want to understand how well the business is doing. Now, how do you determine how well a business is doing? Based on several parameters, like what is the ratio of its gross profit to sales, GP ratio, right? What is net profit ratio, right? What is operating ratio? What is the ratio of current assets to current liabilities? That is, what is liquidity ratio, correct? So there are so many parameters, so many grounds through which we try to understand how well a business is doing. Just like that, we also want to understand how well an economy is doing. Right? We also want to understand how well an economy is doing. And for that, we need to know about national income. See, national income is one such parameter which helps us to understand the performance level of an economy. It's one parameter. There are, of course, other parameters as well, right? But one of the strong parameters that we use is national income. See, just as there are conventions, accounting conventions, which are used to measure the performance of the business, there are conventions for measuring the economic performance of a nation. So just like we use accounting conventions to measure the performance of business, in the same way we use national income or other conventions as well, which are used to measure the performance of the economy. One of such important measures is national income accounting, which was pioneered by Nobel Prize winners Simon Kuznets and Richard Stone. Okay, the concepts of national income were pioneered by Simon Kuznets and Richard Stone. They were Nobel Prize winners. Okay. Now, this was the introduction part. Enough for the introduction. Now I'm going to go to the main topic, the core of the unit. There are two parts of the unit that we are going to cover up. Okay. Though several Chotu topics, small topics will be covered on the way. But the two most important parts of this unit are, number one, understanding about the concepts of national income, and number two, understanding about the measurement of national income. Okay. So, first, let's go through the significance of national income. Why do we need to know about national income? Only then we would be interested in understanding the concepts and methods, right? So, significance of national income. Why is it important to understand national income? So, there are several points which have been given. Number one, it is useful for analyzing the short-run performance of an economy. So, if we want to understand, for example, how well an economy has done during a particular year, short-run performance, right? Then we can use national income as a parameter. Okay. Second, to give a clear picture of the economy regarding the GDP, national income, per capita income, savings ratio, production, consumption, disposable income, capital expenditure, etc. I think you would be familiar with most of the terms written here, but still we are going to discuss many of them as we progress further. I'll just give you the meaning of the ones that you do not know at all. GDP, national income, per capita income, I think you would have heard, of course. Savings ratio is the ratio of total savings to total income. Okay, so out of the total income, how much part is saved? That is savings ratio. Okay, then production, consumption, disposable income is the income that we can use. The income that an individual can dispose at his will, the one that he can use at his will, that is known as disposable income. That is again a topic which will be covered once we move ahead to the concepts part. Okay. Capital expenditure, again you know, right? So in order to understand all these aspects of the economy, it is important to study national income. Third, to evaluate the living standards, income levels, expenditure and consumption patterns of the people. See, in order to understand what kind of a lifestyle people are enjoying in the country, national income is very important. So generally it is observed that if the national income of the country is higher, people in the country enjoy a higher standard of living. And if the national income in the country is lower, people of the country do not enjoy a good standard of living. And that is why we say that higher the national income, more developed is the nation. Okay. Next, to indicate the level of economic activity, economic development and aggregate demand for goods and services, that is to indicate the way in which an economy functions. So three important things are reflected by the understanding of national income. Number one, level of economic activity. Guys, what do we mean by economic activity? What is economic activity? Any activity which is done with the intention of earning some economic benefits out of it. Okay, so when you produce something, you sell something, right? You provide some services, or even when you consume goods and services, all these activities are done with the intention of earning some economic benefit, right? And those economic benefits, when they become the center of any activity, then we say it's an economic activity. So the national income accounting will help us to understand the level of economic activity. Number two, it will help us to understand the economic development of, and number three, it will help us understand aggregate demand for goods and services. What is aggregate demand? Total demand. Total demand for all goods and services combined. Okay. So this is again a significance and importance of national income. Coming to the next point, national income helps the government in determining the national priorities. This is a very good point. See, national income analysis helps the government to set priorities. Obviously, government has limited resources, right? Government cannot be spending unlimited amounts in the economy, right? They have limited resources at their disposal. So they would want to spend wisely, judiciously. They would want to spend in such a way that the economy as a whole benefits in the best possible manner. So how do they prioritize? How do they decide that we need to spend more amount in agriculture sector? How do they decide that we need to spend more amount on education? How do they decide that we need to spend more amount on healthcare services? How do they make such decisions? National income provides them the grounds to make such decisions. Okay, so the national income understanding helps the government in determining national priorities such as education, inflation, unemployment, defense, social development and industrialization, etc. in long term as well as medium term planning. Okay, now a while back when we were discussing the points on the previous slide, there was a point which said that national income helps us to understand the short-term performance of the economy. In this point, they are saying that national income helps us in preparation of medium-term and long-term planning. That means national income has some use for us in short-term, medium-term and long-term. In short-term, it helps to understand the performance of the country. In medium and long-term, it helps the government to make decisions regarding choosing the national priorities of the country. So either ways, it's important in all three time periods. Correct? So that is how you can remember it. Next point. To determine the level of economic welfare. To decide that what kind of an economic welfare are people enjoying in the country. For that also, we need to know about national income. Like, we need to know the amount and distribution of national income. Okay, see, just the amount of national income is not enough. Keep this in mind. Just the amount of national income is not important. We also need to understand how the national income is distributed. That is very important. No matter how high the national income of the country is, but if it's not properly distributed, it is not going to help improve the standards of living of the people. Okay? So, amount and distribution of national income, per capita income, as well as its growth over a period of time. So, how much is national income? How is it distributed? How much is the per capita income? And in what pattern are they growing? Over a period of time, what is the growth that we observe in national income and per capita income? That is what is going to help us understand the economic welfare of the people. Right? Next, it helps to interrelate different sectors of the economy and the shifts in the sectoral contribution over a period of time. Okay, we know that entire economy is mainly divided in three sectors. Which three sectors? Primary sector, secondary sector, tertiary sector. Right? Primary sector includes all agriculture and allied activities. Secondary sector is the industrial sector. And tertiary sector is the service sector. So we know that the economy is divided into these three main sectors. Now, in order to understand that what is the role that each sector is playing in the economic development, we need to analyze the national income. By understanding what is the contribution that each sector is making in national income, we can understand the relative importance of that sector in the economy. And also by analyzing the trends of national income, we can understand the sectoral shifts. Sir, what is sectoral shifts? I'll tell you. I'm sure everybody would have heard this somewhere at least. See, when you were studying in school, or I don't know, maybe even in CA Foundation somewhere, you might have been told that as an economy develops, the contribution of agriculture sector in national income decreases and the contribution of industrial and service sector increases. Right? You might have heard this. Give a little pressure to your head, you might recollect it. So agriculture sector's contribution goes down and industrial and service sector's contribution goes up as a nation develops. This is what we have learned. That is nothing but sectoral shift. That is what you call sectoral shift. Okay. So national income analysis also helps to understand that. Next point. The national income analysis helps to provide a quantitative database for macroeconomic modeling and analysis. So national income data helps us to overall judge the economy, overall decide about the policies of the economy in two different ways. See, number one, it helps in choosing economic policies. So based on national income data, the government can choose a policy which it thinks is most suitable for the economy. Right? Not only can the government decide which policies should it adopt, but it can also evaluate the chosen economic policies. So after implementing a particular policy, if we find that national income is rising, then it would suggest, it would hint that the policy chosen was appropriate. It was a successful implementation as well. But if somehow we find that after implementation of a particular policy, the national income has started dropping or the increase in national income has slowed down, then that would indicate that the policy was not so fruitful for the economic development. Okay, so this is also a use that we can have for national income analysis. Going to the next point. The national income analysis helps in the determination of monetary, fiscal, and trade policies for faster growth. The monetary policies, the trade policies, the industrial policies, fiscal policies, these are all somehow affected by national income. Okay, now what is monetary policy? We actually have a very detailed discussion of monetary policy in chapter 3. We have an entire unit dedicated to monetary policy, but just to explain its meaning in one sentence, monetary policy are the measures which are taken by central bank to ensure overall economic stability. Okay, just a basic understanding. Same way, fiscal policy are the measures which are taken by central government. Monetary policy is designed and implemented by central bank, and fiscal policy is implemented by central government. Intentions are more or less same. Okay, they both are somehow working on the same lines. Trade policy is about international trade policy. Okay, so even for determining these policies, national income analysis is useful. Then to make projections of the country's development, projections, that is estimates, forecasts, that how a country is going to develop, how much will be the growth rate in the coming years. Okay, so for economic forecasting at macro level, national income analysis is useful. Okay, so sir, is national income helpful only in long-term forecasting, macro level forecasting, or is it also helpful for micro level forecasting? See, it's also helpful for micro level forecasting. The next point is going to help us understand that. Based on national income, we can assess future consumption patterns. See, we can analyze the trends of demand in the economy based on national income data. And using those trends, we can try and have projections, forecasts about the demand of goods and services in future. Now, this forecast will help the businesses to forecast their demand. The businesses would know that what kind of a demand is the economy going to have in future, and based on that they can forecast that how much of their product will be sold in future, considering the current economic trends. Okay, so it is micro level forecasting as well. So you can remember the 2 points this way, that it helps in macro level forecasting as well as micro level forecasting. At macro level, it helps to understand about the uh, overall changes that will be occurring in the economy, entire economy, not just one particular business. Okay. And at micro level, it will help the businesses to forecast based on the demand patterns, analysis of demand patterns, right? And next, to make comparisons of structural statistics. Comparisons of structural statistics, what do we mean by that? Like, we can find out ratios of investment, taxes, government expenditure, etc. to GDP. So what does this mean? See, GDP, I think you must have heard of the term, though we are going to discuss that in detail in a while. But the term simply means the measure of all the goods and services produced in the country. That is GDP. Okay. So GDP is a very important measure which helps the government to decide how much should they spend on each particular segment of the economy. Okay. And based on GDP, we can find out several ratios. GDP calculation is a part of national income accounting, right? And based on this GDP, we can try and figure out that how much is the government spending from the total GDP, how much is government spending on education, how much is government spending on defense, how much is the government investing, right? All those calculations, all those ratios can be figured out based on GDP. I am not sure if you would have heard this, but a few months back, rather more than a year back, there was a comparison between the percentage of GDP which India is spending on education versus other countries. And it was observed that India spends quite low on education out of its total GDP as compared to other developed countries. So this is a good analysis. It helps to understand that what exactly is the country focusing on, right? So all such ratios can be calculated. Then pattern of income distribution can be understood. Comparison with other world countries data can also be made, right? So these are some of the significances, some of the uses of national income. Okay, I hope you understood all this. Okay, now as I committed, we are going to go to your notes now to cover up these topics. There is of course going to be something extra in your notes as well, many a times, right? This is just to understand the overall concept. The presentation part is going to help you understand the detailed discussion, the at length discussion, some additional points, that is all going to be there in your notes. So now let's go to notes and try and understand the points that we have already covered. Let's see how they are presented there in the notes. Okay. So in your notes, chapter 1, unit 1, national income accounting. First of all, we have been given what is national income. This is nothing but that introduction that we went through. So very quickly, I'll help you mark. Just as there are accounting conventions which measure the performance of business, there are conventions for measuring and analyzing economic performance of the nation. And national income is one such measure pioneered by Nobel Prize winning economists Simon Kuznets, Richard Stone. Now these two definitions of national income is something that you do not have to worry about right now. The definitions given here are a little more technical, and so we are not taking up them right away. Once we go through some more concepts related to national income, then after we'll be in a better position to understand these definitions. So for now, you can park them aside. Okay, you can just write their definitions of national income, but we'll be discussing them later. Now, why is the study of national income important? This is your second point. So why is the study of national income important? Is nothing but significance or you can even say usefulness national income. Okay. Now, it's more or less the same points that we have covered in the presentation. The language might differ at places, but points more or less are same. See. So, national income accounting helps in analyzing and evaluating the short-term performance of the economy, and it also helps to understand the level of economic activity and economic development, as well as aggregate demand for goods and services of the country. Okay. Then the distribution pattern of national income determines the pattern for demand of goods and services, which helps the businesses to forecast, the micro level forecasting that we talked about. Then economic welfare also depends on magnitude and distribution of national income. So how much is national income and how is it distributed? Both of these factors are going to determine the economic welfare of the people, right? Also size of per capita income and its growth over period of time. Then the sector specific targets can be fixed by the government based on national income analysis. That priority sectors can be decided, right? The point that we covered. So government can formulate suitable development plans and policies accordingly to increase the growth rates, and for this the government can obtain the following information from national income analysis. Number one, the government can obtain information about the composition and structure of national income in terms of different sectors of the economy, their periodical variations, and broad sectoral shifts over a time. Okay, so government can know that how much is the contribution of each sector in the total national income, how is that contribution changing, how is it shifting over a period of time, right? Government can also have temporal and spatial comparisons. Okay, sir, what do we mean by temporal comparison? Temporal comparison is guys time based comparison. Comparison based on time period. So for example, if I say that I am comparing India's economy in 2015-16 and 2019-20, then this is known as a temporal comparison. I am comparing based on two different time periods. Okay. Spatial comparisons is comparison made based on differences in area, geographical area. Okay, so if I compare the Indian economy with the US economy in 2019-20, Indian economy versus US economy, this is a spatial comparison. Okay, so time based comparison is temporal comparison, space based या तो place based comparison is spatial comparison. Okay, so these can also be made with the help of national income analysis. Now, national income statistics provide a quantitative basis. They provide a quantitative basis for assessing and choosing the economic policies, right? It helps the government to decide which policies should they implement, and also it helps in the evaluation on the government policies. Whether the government policies chosen in the past were good for the economy or not, that can also be understood with the help of national income analysis. Then it is useful in understanding income distribution and the possible inequality in the distribution among different categories of income earners. It is possible to make comparisons of ratios of investment, taxes or government expenditure to GDP. Now, this eighth point is also a very good point. The international comparisons in respect of incomes and living standards help in determining what? Important, huh? Pay attention. Determining the eligibility for loans and other funds or conditions on which such loans or other funds are made available. So what does this mean? We did not understand anything. Okay. That is expected of you, don't worry. What the point says is that, for example, let's say if India wanted to become a member of IMF, India is already a member of IMF, but when India wanted to become a member of IMF, on what parameters, on what grounds will IMF decide the fund which India will have to contribute to IMF? You understand IMF is a fund, right? International Monetary Fund, right? So whenever we want to become a member of it, we'll have to make some contributions. So on what grounds will those contribution amount be decided? There are certain parameters. One of it is national income. Okay. Similarly, if we are applying for a loan in any such international institution like World Bank or IMF, then the eligibility of loan also depends upon national income. Just like when you want to apply for a home loan or a car loan or a personal loan or whatever, the bank will ask for your papers, right? Your income papers, income proofs. The same way, IMF and World Bank are also going to ask for income proofs from the country, right? For that, national income is useful. Okay. The national income data are also useful to determine the share of nations' contributions to various international bodies. Okay, this is something I already told you. And lastly, combined with financial and monetary data, national income data provide a guide to make policies for growth and inflation. So how to control inflation, how to increase the growth rate, how to monitor the growth rate. For that, whatever policies we need to make, we can make that based on the data obtained from national income analysis along with other data, monetary data as well. But this is also one of the requirements for that. Okay, so these are all different points which signify the significance, importance of national income. Okay, sir, how many points do we need to remember? No matter how much I explain, right? The most important part will be how much do we need to remember. Okay, as such, since you will be facing only 2 marks / 3 marks questions, it is not expected or required of you to remember all the points. But I suggest that you remember at least 6 to 7 good points from the list. You choose the ones you are comfortable with. Okay, and don't just try to rule out the big points. Okay, because big points might be a combination of several chotu points. So don't leave them out. They are important. Okay, so please don't make the size of the point be your choosing criteria. That will not be a wise choice. So this is your significance of national income. Okay, now we are going to go to the next topic. Now people, we are going to come to concepts of national income, one of the most important topics from this unit. Okay, so pay attention, no sleepy time now. Not like you are supposed to sleep in any other discussion, but not definitely in this one. Okay, if you sleep in this, you are going to curse me when you are going to write your papers. I don't want to be cursed. So pay attention, stay awake. Now, what are concepts of national income? See, in order to understand national income, we need to understand several parts or several components from which national income is made up of. Now, there are various such components that we are going to be covering up here. One is GDP. I am sure this is the most commonly known topic to everyone. Then comes NDP, then GNP, NNP. These four are the main ones. These are important for understanding national income. The next three that are coming up in the list, they are related to national income. They are not exactly about national income, but somehow connected to national income. That is per capita income, personal income, and personal disposable income. Okay, so these are the 7 main concepts related to national income that we are going to cover in our discussion. I am starting with the first and the most important one, that is GDP, gross domestic product. Okay. Now, what do we mean by gross domestic product? See, understand that we are talking about gross domestic product. So we are talking something about production. Now, sir, what do we mean by production? See, in economics, production means goods and services both. Manufacturing goods is also a part of production in economics, and providing services is also a part of production in economics. So when I speak of the word production in economics, it includes goods as well as services both. Okay, so that is first thing that you need to know. Now, what exactly do we mean by GDP? See, in a simpler sense, very general sense, GDP is nothing but the total of all goods and services produced in the country in a year. The total of all goods and services produced within the country in a year is known as GDP. But this is just a very plain, very basic definition of GDP. GDP is not so, general, not so common. It's a technical term, so has to be defined accordingly. So what is the technical definition of GDP, sir? How do you define GDP technically? See, this is the technical definition of GDP, okay? The money value of all final economic goods and services. The money value of all final economic goods and services, gross of depreciation produced within the domestic territory of the country during an accounting year is known as GDP. Okay, once again, the money value of all final economic goods and services, gross of depreciation, produced within the domestic territory of the country during an accounting year is known as GDP. Now, the question is, what does all these terms mean? Final economic goods and services, domestic territory, gross of depreciation. What do we mean by that? See, that is something that we are going to learn and understand now. In order to understand the definition of GDP, in order to understand the depth of GDP, we need to dissect this definition into smaller parts. Okay, so we are going to perform a post-mortem of this definition. We are going to analyze each chotu part of this definition thoroughly. And once that is done, we'll be able to have a comprehensive understanding of this definition. Until and unless we understand all the parts of this definition, the definition will not be clear. And therefore, we are going to be taking up these parts. Among them, we are going to be discussing 1 about money value, 2 about final economic goods and services, 3 about gross of depreciation, 4 about domestic territory, also to some extent about the accounting year part, but not in the same sequence. Okay, sequence I will change according to my requirement, but we are going to be understanding about all these terms that are used in the definition. Also, read this. It includes the value of goods produced by the normal residents. This is also a term that I want us to understand. Normal residents. What are normal residents? We'll be covering that up as well. So, it includes the value of goods produced by the normal residents of the country and the foreign residents and the foreign owned firms. Okay, so this is meaning of GDP. But as I told you, it is not possible to understand the meaning until and unless we understand that what do we mean by all these different aspects of GDP, all these different segments which make the meaning of GDP complete. We need to first understand them, and among them I am opening my discussion with final goods and services. So sir, what do we mean by final goods and services? Okay. The term used in the definition was final economic goods and services. I'll first tell you what do we mean by economic goods and services, and then I'm coming to final goods and services. The economic goods and services means those goods and services which are meant to be exchanged in the market against some economic returns. So if there are goods and services that you are planning to sell, if they are produced with the intention to sell, okay, if the idea is to market them, or I can say that if they can be marketed, if they are marketable, then we say those goods and services are economic goods and services. So now what are final economic goods and services? Final goods and services can be understood only when you understand its second half, its complementary term, which is intermediate goods and services. Okay, so these two words are understood together: final goods and services and intermediate goods and services. Intermediate goods and services, people, are those goods and services which are not used directly by the final user. They are not used directly by the final user. Instead, they are used to produce something else, to produce some other goods and services. See, I will give you the simplest understanding of intermediate goods and services. Okay, listen to me very carefully. The goods and services whose value is included in the value of other goods and services, they are known as intermediate goods and services. Once again, the goods and services whose value is included in the value of other goods and services, they are known as intermediate goods and services. Okay. On the other hand, the goods and services which are complete, they are no longer required to be processed further. They are directly used by the final user. Such goods and services are known as final goods and services. Okay. So, I'll give you an example to simplify. Let's say this shirt, okay, now it's made up of cotton. Let us say cotton was worth rupees 100, which was used up in the process of producing this shirt. The shirt values, let us say rupees 500. So, in this particular example, the value of cotton is already included in the value of shirt. What say? The value of cotton, that is 100 rupees, is already included in the value of shirt. Obviously, the guy who produced the shirt would have considered that 100 rupees worth of cotton while deciding that he wants to sell this shirt for 500. Do you think he will decide the selling price of the shirt without considering the cost of cotton that he has spent? No. That 100 rupees cotton is already considered while calculating the price of this shirt. That means that the value of that cotton, that 100 rupees, is already included in the value of the shirt. That means in this example, cotton is intermediate goods and shirt is a final good. Clear? Cotton is intermediate, shirt is final. Right? There are several examples that you can see. Wherever, for example, if I give you another example, that in the manufacturing of an automobile, let us say a car is being manufactured, the cost of the tires that obviously the company would have purchased from somebody else, that is an intermediate goods. Tires are intermediate goods, car is a final good. Why? Because the value of tire is already included in the value of car. Okay, so that is what you mean by intermediate goods and final goods. Now, why is this discussion relevant here for us? Let us understand that. See, while calculating GDP, we would want to take up the value of the goods and services produced in the country. But we would not want to add a same good again and again in that production. Whatever counting we are undertaking for measuring the production value, we do not want the same good to be repeated again and again in that production counting. So there are two ways of solving this problem. Okay, please listen to me carefully. Okay guys, this is technical, pay attention. We do not want a single commodity to be counted twice or more than twice while valuing GDP. So what do we do about it? There are two ways to work around it. Number one, we can consider the value of only final goods. We can consider the value of only final goods. That means in our example, the shirt wala example, we will be considering the value of shirt but not cotton. While calculating production, we will be considering only the value of shirt, not cotton. Why? Because the value of cotton is already included in shirt. So if you now say, okay, cotton worth rupees 100, shirt worth rupees 500, so total production in the economy is 600 rupees. That is incorrect. It's incorrect. Why so? Because the worth of 100 rupees of cotton is already included in the 500 rupees valued shirt. And therefore, while valuing the production, I am only going to consider the value of shirt, not the value of cotton. So that is approach number one, where you consider only the final goods. You ignore intermediate goods. Just like you ignore me during the lecture, you ignore the intermediate goods. Okay. The second approach is that you add the value of both. You add the value of cotton as well as the shirt. But you cannot add the full value of all the products. You can only add the value addition made by the producer of that product. Okay? Understand now? Pay attention. No sleepy time now. Pay attention. For manufacturing that shirt worth rupees 500, the producer had to buy cotton worth rupees 100. Right? So, can the producer claim that the entire 500 rupees worth has been added by him? No. Out of that 500, 100 rupees worth has been obtained from the producer of cotton. And therefore, what is the value addition made by the producer of the shirt? The producer of the shirt has made a value addition of only 400 rupees. 500 minus 100. Because 100 rupees value was not added by him. It was given to him by somebody else. Correct? So, by the value addition made by the producer of the shirt was only 400. So now you want to add the value of both goods. Okay, you add only the value addition part. So 100 rupees worth shirt. Okay, and 400 value addition, 100 rupees worth cotton, plus 400 rupees worth value addition made by the producer of the shirt. So 100 plus 400 will give you 500. Either ways, the amount added to GDP will be 500. Two approaches, whichever you use, the amount added to GDP will be same. Either you consider the value of only final goods, or you consider all the goods but don't consider their full values, consider only the value addition made at each stage. Understanding the point? Okay, this is what we are going to understand here in final goods and services. So let's see. Final goods and services. To avoid duplication while calculating GDP, either only the value of final goods and services are considered, or only the value addition at each stage of production is considered. Okay, so as I told you, there are two ways of avoiding this duplication. Number one, you take the value of only final goods, right? Or option number 2, you take the value of all goods but take only the value addition, at each stage, not the full value, right? So the intermediate goods used to produce other goods rather than being sold to final purchasers are not counted, as it would result in double counting. So those intermediate goods which are used to produce something else and they are not sold to the final purchaser, such goods are not considered in GDP. Why? Because it would result in double counting. Double counting means counting the value of one goods 2 or more than 2 times. Okay. And what is intermediate consumption? Intermediate consumption includes the value of all inputs used up during the production, but very important, remember this part, but does not include what? Intermediate consumption. It does not include what? It does not include the consumption of fixed capital. What is consumption of fixed capital? Consumption of fixed capital means depreciation. What? Consumption of fixed capital means depreciation. So it's logical that whenever we are producing something with the help of some fixed assets, that fixed asset is particularly going to be depreciated. We are using it, so its life is going to be reduced to a certain extent, right? That is what we say is depreciation. So it is definitely going to be depreciated, but that depreciation, that consumption of fixed capital will not be considered as your intermediate consumption. Why? Because consumption of fixed capital is treated separately as depreciation. We have a particular way in which we deal with depreciation. Depreciation should not be considered as intermediate consumption. Okay, so the consumption of fixed capital is not considered here because it is recorded separately as depreciation. Okay, please guys, don't get confused here. Intermediate consumption means the consumption of all those goods and services which is done for producing something else, right? Even though a part of fixed asset is consumed during the process of production, we understand and agree that a part of fixed asset is used up during the process of production, but still we do not consider that as intermediate consumption because that is treated separately as it is treated separately as depreciation. Okay, it is not a part of intermediate consumption. Please keep that in mind, right? Now, we have one example as well, one more example. We have taken a couple of examples already. We have one more example that we are going to cover. But before that, I want you to understand one more thing about this intermediate consumption. See, remember the example that I gave you a while ago about that automobile and tires. Okay, so let's take a realistic example. For example, Hyundai produces a car. Okay, the value of the car, the market value of the car is 10 lakh rupees. Okay, now to produce and completely make that car usable, they will have to fit tires in it, of course. Okay, Hyundai does not manufacture tires. So let us say Hyundai purchased tires from SEAT. Now the value of those tires which Hyundai purchased was 60,000 rupees. 60,000 rupees. Okay, now can we say that the total production in the country is 60,000 of tires produced by SEAT plus 10 lakh rupees car produced by Hyundai, so total 10 lakh 60,000? Will that be correct? Not correct, right? Why? Because the value of those tires, that is rupees 60,000, is already included in the value of the car. So it will not be correct on our part to include both of them in GDP. So as we know the technique now, we will ignore the intermediate goods and will consider the value of only final goods. So final goods value, that is rupees 10 lakh car, will be a part of GDP, but 60,000 rupees worth tires will not be a part of GDP. Simple. Now, there can be a twist in the story. What can be the twist, sir? See, the thing is that it might be the case that I am using a car, let us say, and it's been more than 3 years since I've been using the same car, and I have used it quite a lot. So the tires have worn out. You understand this, that tire have a particular life. After a certain period of time, they need to be replaced. So I go to the market, I purchase brand new CEAT tires, and to get it fit in my car, I purchase brand new CEAT tires, and I pay, for example, 60,000 rupees for that. Now this 60,000 rupees, which I am directly paying to the shopkeeper or to the store directly, will be considered as a part of GDP. Why? Because this 60,000 which I am now paying is not already included in the value of the car. It was not intermediate goods here. In this example, in the last example, it was not intermediate goods because I purchased the tires on my own to get it affixed in my car. Okay, it was not already included in the value of the car. Getting the point? So please do not have a fixed notion always that these goods are always intermediate and these goods are always final. No, that is not always the case. There can be a good which can be intermediate and which can be final in different scenarios. Just like in our example, the tires that we were talking about, when the value of those tires were included in the value of the car, then it was considered as intermediate goods. But when the value of those tires was not included in the value of the car and we purchased it separately, I was the final user of that car. I was not buying it to produce something else. Then those tires become final goods. Okay, I hope that is clear to you. So keep this in mind. See one more example, the one that you will love thoroughly. Okay, you see several food ingredients here on your screens, and we have what chilies and oreganos and tomatoes and cheese and capsicum, right? Several things. Now using all these things, we'll be able to produce something, right? What can we produce using this? Yes, we'll be able to produce one of your favorite dishes, that is pizza. Okay, now here in this example, all those ingredients that we were looking at, they are all considered as intermediate goods, and the pizza that is produced with the help of those ingredients is considered as a final good. People, don't be distracted. We are still talking about final goods and intermediate goods, not discussing pizza, okay? Stay focused on studying, not on pizza. Okay. Now, this was about final goods. Okay, we were dissecting and analyzing that definition of GDP into several parts. The first part for that we have covered, that was final goods. Now we are talking about the second part, that is called domestic territory. Okay, if you remember while reading that definition, there was a term domestic territory. I'll repeat the definition for your reference. The definition that we learned about GDP was the money value of all final economic goods and services gross of depreciation produced within the domestic territory of the country during an accounting year. So we now need to understand what exactly do we mean by domestic territory. Sir, it's simple, we know this. Domestic territory is the boundary of the nation, the borders of the nation. Whatever is within the borders is the domestic territory. Well, that is not the case. Not entirely, at least. Though the political borders that we have, area covered within those borders is a part of domestic territory, but not only that part is domestic territory. The domestic territory can go beyond those political boundaries as well. Okay, so what exactly is domestic territory? Let's see. By the way, domestic territory is also known as economic territory. Okay, now read this definition. According to United Nations, economic territory or domestic territory, one and the same thing, is the geographical territory administered by a government administered by a government, that means it's controlled by a government, within which the persons, goods and capital circulate freely. So if we are talking about India's domestic territory, all those areas, all those geographical areas which come under the administration of India's government and within which the people of India, the goods of India, the capital of India can freely move, then we say that area is a part of India's domestic territory. Whether it is within the political boundaries of the country or beyond it does not make any difference. Okay, now you might be wondering that, sir, how is it possible that the government of India has administration over an area which is outside the political boundary of the country? How is it possible? It is possible. Let's consider the inclusions of domestic territory. Okay, what all things are included in domestic territory? First of all, of course, the political boundaries of the country, including the territorial waters. Territorial waters are up to 12 nautical miles from the coastal line of India. So up to 12 nautical miles is still considered as a part of India's political boundary. Okay, so India's political boundary as well as territorial waters, they are all considered as a part of domestic territory, of course. Other than that, now it gets interesting, huh? The ships and aircrafts, okay, which are owned and operated by the normal residents between two or more countries. Okay, the ships and the aircrafts which are owned and operated by the normal residents of the country between two or more countries. I'll give you an example. Let's say Air India. Okay, now Air India, it has started a service, a flight service, which in which the flight commences from, let us say, Japan. The flight departs from Japan and it goes to, for example, Dubai. Okay, from Japan to Dubai. Now, understand, both Japan and Dubai, both are outside the political borders of India. Correct? Right? They are other countries, foreign countries. Even then, the services provided on that flight and that flight service itself will be considered as a part of the production activity undertaken within the domestic territory of the country. It will be considered as the production activity undertaken within the domestic territory of the country. Why? Because the definition of domestic territory includes any ships or aircrafts which is owned by normal resident. Air India is a normal resident of the country, right? So it's an Indian company. So owned by and operated by the normal residents of the country between two or more countries. By definition, it is included in domestic territory, and therefore the production activity undertaken in that domestic territory will be a part of GDP. Okay. Then third, the fishing vessels, oil and natural gas rigs and floating platforms. Okay, you might not have seen oil and natural gas rigs, so I have kept a picture of that for your reference. These are oil and natural gas rigs. They are exactly designed to extract oil, natural gas from below the surface of the earth, underwater beds. Okay, they try to extract oil and natural gas from that. So these fishing vessels, oil and natural gas rigs and floating platforms, they will also be considered as a part of domestic territory if they are operated by residents in international waters. International waters means the waters which do not belong to our territory. It is not part of India's boundaries. Okay, that is international water. So if they are operated by our residents in international water and where they have exclusive rights of operation. They have exclusive rights of operation means nobody else can extract those oil and natural gases from there, or nobody else can operate there. then we can say that the services provided there are also a part of production activity undertaken in our domestic territory, even if they are undertaken in international waters. Okay. Fourth, this I think you will easily understand. The embassies, the consulates and the military establishments in other countries. So for example, if Indian embassy situated in Singapore, okay, Indian embassy situated in Singapore, that will be considered as a part of our domestic territory. Even though it's in Singapore, but it's considered as a part of our domestic territory because it is administered by our government. Understand, it's administered by our government. The movement of people, goods and capital is free over there. That government cannot restrict the movement of people, goods and capital within that embassy. So it is a part of our domestic territory. Okay. So these are the four things which are included in the definition of domestic territory. Sir, what is excluded? I think if you understand the inclusions, you will understand the exclusions quite easily. But still, let's see exclusions from domestic territory. Just like our embassy, our consulate, our military establishments situated in other countries are a part of our domestic territory, the same way the embassies, military establishments and consulates which are situated in India but they belong to other countries, then they are not a part of our domestic territory. Okay, they are not a part of our domestic territory. Similarly, the international organizations like UNO, WHO, etc., which are located within the geographical boundaries of a country. So for example, the WHO office which is located in USA will not be a part of the domestic territory of US. It will not be a part of domestic territory of US because it's an international organization. It will not be a part of domestic territory of any country. It will not be a part of domestic territory of any country. Okay. So this was the meaning of domestic territory. Clear? So while understanding GDP's definition, we are now clear with the meaning of final goods and services. We are now clear with the meaning of domestic territory. Two things we have covered so far. Now we are going to the third concept that I want you to understand, that is normal residence. Remember, there was a term used in the explanation of GDP that it includes the production by normal residents as well as the foreign residents and foreign owned firms. So sir, what exactly do we mean by normal residents? Do we mean that the citizens of India are normal residents of India? Is it necessary? No. From economic point of view, especially for national income accounting, they have very clearly mentioned what normal resident means. So what is normal resident? Let's see. A resident is said to be a person or institution. Could be a person, could be an institution. So a company can also be a resident, okay? Who ordinarily resides in a country, and whose center of economic interest lies in that country. Center of economic interest, that means he either produces goods over there, or he earns his income from there, or he spends a substantial part of his income there. Then we say that he has a center of economic interest in that country. So understand, two things are required for a person to be considered as a normal resident of a country. Number one, the person should be ordinarily residing in that country. Number two, the person should have it should be center of his economic interest. The center of his economic interest should be in that country. So when these two conditions are satisfied, then we say that the person is a normal resident of that country, or to be simply said, just the resident of that country for national income purposes, okay, GDP purposes. Now, sir, what do we mean by the term he is normally residing there, ordinarily residing there. What do we mean by that? So a further clarification has been given for that. So he is called a normal resident since he normally lives in the country of his economic interest. The period of stay, remember this, the period of stay should be at least 1 year. Period of stay should be at least 1 year. Okay, so that is considered as ordinarily residing. Doesn't matter if he is citizen of India or not. Okay, even a foreign citizen, if he is residing in India for more than a year and he has a center of economic interest here, then we say that he is the normal resident of the country. Okay, some tourist comes to India and stays here for a couple of months or a few months. That does not make him the normal resident. Okay, okay, he has to stay here at least for 1 year and his center of economic interest should be here in India. Then he becomes the normal resident for India. So two conditions: staying for more than a year and having economic interest, that is either earning or spending or accumulation, anything. These are the two conditions for becoming normal resident. Okay, just to clarify, these are the persons who will be included in the definition of normal residence. If we are talking in terms of India, these people or institutions will be a part of normal residence. Number one, the citizens and institutions of India, of course, they are Indian citizens and Indian institutions residing in India for a period of at least 1 year and have economic interest here, then it is they are normally considered as the resident of the country. Citizens of other countries can also be our normal residents. Citizens of other countries, that is non-citizens, who normally reside for more than a year and whose center of economic interest lies in India. They are also included in the definition of normal residents. Third, citizens of India, Indian citizens who are working in international bodies like IMF. See, they are working in international bodies. Now, international body does not belong to any particular country. So, they will continue to remain our normal resident even if they are working in international bodies. Number two, they are working in foreign bodies like banks, enterprises which are being operated in India. So, an individual who is working in a foreign bank, let us say Standard Chartered Bank. Now, if he is a citizen of India, normally resides here, he earns his money from here, doesn't matter that he is working in a foreign bank, he will still be considered as resident of India. Okay. Similarly, any individual, Indian citizen, who is working in foreign embassies located in India. So, an Indian citizen is working in, let us say, US embassy, which is located in India. US embassy located in India. Then, this individual will be considered as normal resident of India. Simple? Okay, so I hope this is clear to you, right? So, as of now, we are clear with the meaning of number one, the final goods and services. Number two, we know the meaning of domestic territory. Number three, we know the meaning of the normal resident. Okay, these are the concepts that we have covered with reference to the GDP definition. Okay, don't forget from where all these terms have originated. We are just trying to understand the definition of GDP so far. Okay, so simple. Now, the next thing that we are going to talk about is the money value of GDP. See, remember when reading the definition of GDP, what we read was the money value of all final economic goods and services. Now, what exactly does this money value mean, sir? And why do we need money value in the first place? Okay, the idea of GDP is to add the total production of goods and services which is undertaken within the domestic territory of the country. right? Whatever goods and services are produced within the domestic territory of the country, they have to be added. Now, in order to add these, understand, in order to add these, we will have to bring them all to a common unit of measurement. As such, different goods have different units of measurement. For example, milk is measured in liters and cloth is measured in meters. If I want to add 1000 liters of milk, the production of 1000 liters of milk with the production of 1000 meters of cloth, how do I add them? It's not possible to add them directly. Why? Because the 1000 liters of milk and the 1000 meters of cloth has a different unit of measurement. The only way I can add them is by making sure that the unit of measurement for them is common. It's just like you cannot add $100 plus 100 rupees directly, right? They have different units of measurement, so you cannot add them directly. You will have to bring them to a common unit of measurement. Just like that, dear people, in order to add the production of all the goods and services, we have to bring them to a common unit of measurement, and that common unit of measurement is money. Okay, and that is why we have to find out the money value of GDP. Okay, now this money value of GDP can be measured in two ways. There are two different ways of measuring money value of GDP. One, it can be measured at market price. Second, it can be measured at factor cost. Okay, it can be either measured at market price or it can be measured at factor cost. Now, what exactly do we mean by measurement at market price and measurement at factor cost? Let's understand. See, if I'm trying to value GDP at market price, okay, if I'm trying to measure GDP at market price, what I will require to do is, I will require to first of all multiply the quantity of all goods and services produced with their respective market prices. Okay, the quantity of all goods and services produced with their respective market prices. Mind you, which goods and services I am talking about? Only final goods and services. Okay, intermediate goods and services are not to be considered. We consider the value of only final goods and services. And what am I asking you to do? I am asking you to multiply the quantities produced of all final goods and services with their market prices. Okay, this will give me GDP at market price. So simple. So simple. See, quantity produced multiplied by market price of the goods. Easy as that. Okay. Now, sir, how do you find out the money value at factor cost? What do we mean by factor cost? So see, we understand that whatever goods and services are produced, they are produced with the help of factors of production. Goods and produced cannot be produced from, thin air. Goods and services are produced with the help of factors of production. You cannot just fetch them out of the magician's hat. They require production. So, for production, we need factors of production. Factors of production are mainly classified into 4 parts in economics: land, labor, capital, entrepreneur. Right? 4 factors of production. So, it's said that whatever is produced, whatever goods and services are produced, they are distributed among the 4 factors of production based on the contributions that they have made in that production. Pay attention. Once again, whatever goods and services are produced, its worth, its value is distributed among the 4 factors of production on the basis of the contribution that they have made in this particular production. So if I say that calculators worth rupees 10 lakhs have been produced, calculators worth rupees 10 lakhs have been produced. Okay, in order to produce these calculators, some land, some labor, some capital, some entrepreneurship would have been required. So whatever was their contribution in this total 10 lakh production, depending on that, the amount of 10 lakh should be distributed between them. Such a distribution is going to become their incomes. So owner of land earns rent, laborer earns wages, capitalist earns interest, and entrepreneur earns profit. Correct? So ultimately, whatever is produced is distributed among the four factors of production as rent, wages, interest, and profit. And therefore, if you want to find out the value of production, you can either value it at market price, just like we just understood, or you can value it at factor cost by adding the rent, wages, interest, and profit, which is paid in relation to the production of these goods. Okay, the money value obtained by such an addition of rent, wages, interest, and profit, that is known as the money value at factor cost. Okay, bouncers? No, right? You understood? See, one-liners, just one-liner difference between the two. In value calculated at market price, you multiply the quantity produced at market price. That's it, all done. While calculating the money value at factor cost, you add the factor cost which have been paid out in that production process. That is, you add rent, wages, interest, and profit. Okay, clear? Now, sir, is the value obtained under market price and factor cost same or different? Is the value obtained under market price and factor cost same or different? See, theoretically, it can be same. It can be theoretically possible. Hey, okay. How so? Under what circumstances? Under what theoretical circumstances is money value of market price and factor cost equal? In the absence of government interference. Okay. If there is no government interference, then the money value obtained as market price and at factor cost will be equal. Sir, how does government interference create a difference between the two? What does government have to do about this now? See, the thing is that government can create difference between market price and factor cost with either indirect taxes or subsidies. Two ways. Okay. The difference between market price and factor cost values can either be because of indirect tax or because of subsidies or because of both, of course. Okay. Understand how. When I say that calculators worth rupees 10 lakhs have been produced, now that 10 lakh does not only include rent, wages, interest, profit. Although rent, wages, interest, profit is there, it is a part of that 10 lakhs. But that 10 lakh also has indirect taxes. Whenever you buy calculator, it says MRP inclusive of all taxes and duties. So those taxes and duties are indirect taxes, right? So because of those indirect taxes, what has happened is that the market price is now shown at a higher value as compared to factor cost, because factor cost only has rent, wages, interest, profit, whereas market price now has rent, wages, interest, profit, and indirect tax. Okay, so what do I need to do to equalize them? If I want to equalize market price and factor cost values, what do? I'll just have to remove the indirect taxes from market price, or I can also add indirect taxes to factor cost. Okay, you remember the fundamental logic, which is because of indirect taxes, market prices are higher than factor cost. What? Because of indirect taxes, market prices are higher than factor cost. Okay. Similarly, when government gives subsidies, see, actual rent plus wages plus interest plus profit amount was higher. But since government has given a subsidy, so it is sold at the lower price in the market. So now, because of subsidies, what has happened? That market price is shown at a lower value as compared to factor cost. Understand? When government gives subsidies, it is going to reduce the market price below the factor cost level. So now factor cost is higher and market price is lower. If I want to equalize them, what would I need to do? Two options. Either I can add subsidies to market price, or I can reduce subsidies from factor cost. It's written there, don't worry. It's not just audio that you are going to get, you are also going to get a visual for this. But I hope you are able to understand the difference. Okay, see. In a closed economy where there is no government interference, so government does not intervene, the values obtained at market price and factor cost are same. If it's a closed economy, if there is no government. See, if there is no government, there is no indirect tax, there is no subsidy, there cannot be a difference between the two. In that case, market price and factor cost will be equal. Right? This is because whatever market price is obtained from the goods, it is distributed among the four factors of production based on their contributions, and thus market price would be equals to factor cost. But only when there is no government interference. Okay, don't forget this. However, when government charges indirect taxes, the market prices rise, but the factor cost does not rise. The market price rises, but the factor cost does not rise. Similarly, when the government gives subsidies, the market price falls, but the factor cost does not fall. Factor cost remains the same. Okay, so because of indirect taxes and subsidies, there is a difference created between market price and factor cost values. So the reasons for difference in value of market price and factor cost can be divided in two parts: indirect taxes and subsidies. Now, indirect taxes and subsidies can further be of two types. They can be of two types. Which two types? Indirect taxes can either be taxes on goods and services. Okay, taxes on goods and services, like GST is a tax on goods and services, right? Or it can also be a tax on production. It can be a tax on production. Like, for example, if government is charging some permit fee or license fee from a producer, that will be a tax on production. See, it has nothing to do with the quantity produced. The license fee, the permit fee, right? It has nothing to do with the quantity produced. Correct? However, GST or earlier sales tax, customs duty, all these are related with the quantity of production. So whatever taxes, duties are related to quantity of production, they are known as taxes on goods and services. Whatever are related to the activity of production, regardless of the quantity produced, they are known as taxes on production. In the same way, there are subsidies on goods and services and subsidies on production of goods. Okay, this distinguish is going to be useful in the forthcoming discussion, not now. Okay, I'll again repeat this when I reach there, don't worry. Acha. So, due to indirect taxes, this is important, right? Remember this. Due to indirect taxes, market value is greater than the factor cost. Market value greater than factor cost, and due to subsidies, the market value is lower than factor cost. Okay? Because of indirect tax, market value greater than factor cost. Because of subsidy, market value less than factor cost. From this arises the first fundamental difference of national income concepts. In order to thoroughly understand national income concepts, I have drawn out three fundamental differences from this entire discussion. Whatever discussions we are going to have about concepts of national income, that is GDP, NDP, GNP, NNP, from these I have drawn out three fundamental differences. Among these three, the first fundamental difference is this, the difference between market price and factor cost. And what is that difference? Market price and factor cost difference is nothing but indirect taxes and subsidies. See what's written here. The market price production is calculated on the basis of market value of final goods and services produced, whereas factor cost value is calculated on the basis of cost of factors of production, that is rent, wages, interest and profit. Sleepyheads, stay up, okay? You're able to understand this, right? I'm telling you, if this does not go inside your heads, it's going to be very difficult for you to solve numericals. Okay, fine. So this is just the meaning difference. In terms of formula, I can say that market price can be obtained from factor cost by adding indirect taxes to it and deducting subsidies from it, and the other way around. Factor cost values can be obtained from market price by deducting indirect taxes and adding subsidies. Okay, just take a pause here, think over this formula, make sure that you are able to understand this logically. Why am I deducting market price from, why am I deducting indirect tax from market price? Because indirect taxes are already included in market price. And in order to equalize market price with factor cost, I'll have to remove those indirect taxes effect. The same way, I have to add subsidies to the market price. Because of subsidies, the market prices were lower than factor cost. So I have to add it to market price to equalize factor cost and market price. Okay? Don't just mug up the formula, understand the logic of it. Fine? Now there is going to be a term that you encounter sometime when we move ahead, which is called net indirect tax. Net indirect tax is nothing but indirect taxes minus subsidies. Okay, if you see a term net indirect tax, it means nothing but indirect taxes minus subsidies. Okay. Now, to make sure that this difference of factor cost and market price is set inside your heads permanently, okay, we are going to take one example. You consider this example, you understand this properly, you will not have to mug up anything about market price and factor cost. It will be there embedded in your heads permanently. Okay, see, let's assume that the factor cost of an LPG cylinder is 500. When I say factor cost is 500, what I mean is rent plus wages plus interest plus profit to produce that LPG cylinder is 500. Okay, the indirect taxes charged by government is 100 rupees. So 500 was the factor cost, plus the government is now charging 100 rupees of indirect tax. So at what price will it be sold in the market? It will be sold at 600 rupees. Correct? 600 rupees will be the price. But considering the situation of the poor people, government announced a subsidy of 50 rupees on that cylinder. It announced a subsidy of 50 rupees on that cylinder. Now, what will be the market price? The price payable by the consumer will be 500 plus 100 minus 50, that is 550. And this is your formula. See, factor cost plus indirect tax minus subsidy is equals to market price. Okay, you can deduce it quite logically. You don't even have to mug up. See, okay, clear? So this was the first fundamental difference that we have learned. So now we have understood the meanings of number one regarding the definition of GDP. Now what have we understood so far? We know the meaning of final goods and services. We know the meaning of domestic territory. We know the meaning of normal residence. We know the meaning of money value. Okay, these things we have covered so far. There are still some more topics which are to be covered, but that will be covered as and when we move ahead. Just to make sure that we are able to understand the substantial part of that definition of GDP, I will take you back to that definition. See, the definition of GDP that we discussed. See, the money value. Now, see which terms you understand from this. Okay, you understand what do we mean by money value, correct? Money value of all final goods and services. You understand the meaning of the term final goods and services. Gross of depreciation, that is something which I am yet to discuss. So let it be. Okay. Domestic territory, you understand. Okay. And normal residence also you understand. Right. So this was about GDP for today's session. GDP is not yet over. There are still a few things that we need to understand about GDP so that we can complete this definition and the concept wholly. We will have to cover some more topics, but that will be taking up in the next session. Also, I will be discussing these same points from your notes in the next session. Since it's not all complete yet, so I don't want to jump to the notes right away. Let us first understand the concepts fully and then we'll be going to the notes part. But you can always refer to the notes for your reference. You can always go through the notes. You will be able to relate with whatever we have discussed. But yes, proper marking and all that I will be taking up in the next session. Okay, so I hope you enjoyed this session. I hope you got something to learn, something interesting to understand. Right? It was fun. I hope it was fun. And I am concluding this session here, guys. See you in the next session. And please, till then, take good care of yourself and your families. Stay safe, stay healthy. Bye bye.